Hello everybody and welcome to the 2025 edition of the State of European Mobility Startups. My name is Alex Ten. I'm delighted to be your host for this webinar. Thank you very much for being with us wherever you're watching us here this morning. As you probably know, for the last 4 years, via ID, the Mobility Club and Dealroom have brought out a report on financing mobility startups. So we're going to be very happy to have their analysis and their take on what's happening in the market at the moment, especially in 2024. We're delighted also we'll have a roundtable discussion with Nate Jarrett, who's the General Manager of Manib, and James Jackson, who is the CEO of Bumper. If you have any questions, we hope that you will have questions or any remarks. Please feel free to use Livestorm, and for the last 15 minutes of the program, I will be making sure you get your answers. So please feel free to ask any questions you like via Livestorm. So first of all, I'm delighted to have our representatives here in the studio today. Perhaps it's best if you present yourself. Eglantine, could you tell us about Dealroom?
Yeah, of course. Hi everyone, my name is Eglantine. I'm a research associate at Dealroom. We're a global data platform. We work with government organizations, investors, startups to provide transparency to the ecosystem, and also we build analysis, often in digestible formats such as this report.
Okay, Clément, could you tell us a little bit about who you are and via ID?
Good morning, Alex. Good morning, everybody. It's a pleasure to be here this morning to share this year's figures and insights. So I'm in charge of startup and open innovation programs at VID. VID is the head, is the innovation hub and CVC of Mobivia, the #1 car maintenance company in Europe. And we invest in startups. We have a portfolio of more than 20 startups, such as BlaBlaCar, Hitch, or Gaia, for example. And we also run startup and open innovation programs, such as the Move Lab at Station F, the EUSP with the European Parliament, and we are really lucky to have a strategic partnership with EIT Urban Mobility.
Do a lot of things, apparently.
That's,
okay,
yeah,
Pierre, could you tell us about Mobility Club?
Yeah, sure. So good morning, Alex. Good morning, everyone. I'm Pierre Gonnet. I'm a Corporate Innovation Manager at VID. I'm in charge of the Mobility Club, which is an innovation lab for corporate actors within the mobility sector. Such as Transdev, Total Energy, or Massif, for example. And we deliver different services through the Mobility Club, such as business intelligence report, expert conferences, workshops, etc.
Perfect. So you're the perfect people to discuss with. Please feel free to ask them any questions on them. I'll make sure you get your answers at the end of this webinar. So, Eglantine, after that introduction, I think we can start with your take and your analysis of how things changed in 2024. Could you talk us through that?
Yeah, absolutely. So we see VC investment in European mobility startups reached 6 billion in 2024, falling 30% short of the previous year. We see that's a continuous downward trend from the boom years of 2021, 2022, where massive amounts were being raised in mobility, but also in the rest of tech. There's this correction phase that is happening, again, in mobility, but also in the overall average European markets. Actually, the average drop in Europe was 11%. One interesting fact is that the drop in deal activity and amount in 2024 compared to 2023 was similar, around 30%. When we compare the levels to 2019, we see there's similar amounts of funding, around 6 billion, but a big drop in amounts, in deal activity, sorry. So we see there's less rounds being funded, but the amounts are sustaining. At early and breakout stage, European mobility declined on average 25% in 2024 compared to 2023. Late stage has suffered the biggest drop in recent years, still above pre-pandemic levels. So yeah, we see a lot of this drop is due to late stage, at least in amounts. When we look at deal activity, late stage is actually having an uptick. So what we see is the average deal size is really reducing. In 2024, the average mega rounds were around 100 million, whereas in the boom years, it was around 200, 300 million. So really astronomical levels, which are now being corrected and more reasonable. We see the opposite story in early stage. Amounts are resilient, but deal activity has reduced, similar to the rest of tech. Mobility ranks 5th in top-funded European industry. It was actually 3rd in 2023, so it's had a drop in ranking. That's for sure due to its drop that's really outpacing the average European drop by threefold. Still, there's a consistent interest. Mobility has ranked in the top 5 European industries over the past 10 years. When we look at consumer-focused industries only, it's been in the top 3 over the past 5 years, behind only fintech and food. Corporate investors were involved in nearly half of mobility rounds in 2024, more than doubling their share from 2020. They were also present in most top rounds of the year. So what we can really see is top innovations are being funded by top corporates for the development of their respective sectors. A few notable examples is Groupe ADP de Paris Airport or United Airlines, an American airline, investing in sustainable aviation startups like Skyport, Heart Aerospace that are building electric aircrafts. Also big tech like NVIDIA and Microsoft are investing in Wave and autonomous mobility that raised the biggest round of the year. So there's still a lot of strong signals and prospects for the development of a very solid ecosystem. Infrastructure-intensive EV battery and charging accounted for less than a fourth of European mobility funding in 2024. That's really a big drop from 2023 when it was at its peak, making up half of the sector. So we still saw some big EV charging infrastructure rounds. For example, PowerDot raised in a 100 million round. So they're still there, but there's more of a focus now as we saw the top rounds in sustainable aviation, autonomous vehicles, other types of mobility. We see rest of mobility had its third best year in 2024. Overall, we really see a shift. EVs have been heavily financed in the past years. They're now reaching maturity. They're having a lot of macroeconomic shifts. And so funding is now being more redirected towards technological and scalable models.
Thank you very much indeed, Églantine. Now, Pierre, as we've seen, the financing model for 2024 was a bit different from the years before.
Exactly.
Could you go into that in a bit more detail for us?
Yeah, sure. So as mentioned previously, we see an evolution in terms of models regarding the most funded mobility startups in 2024. The evolution of investment philosophy of funds translates not only into what we said before, an investment into technological models, but also into startups with a more asset-light profile, such as marketplace and e-commerce that we see here, representing 14% of the total funding in 2024, or even SaaS models, with 38% of the total funding in 2024, versus manufacturing that we are seeing is representing 47% in 2024. So after 2023, a year of heavy investment in manufacturing models, 2024 is the first year in which manufacturing has been in decline since 2018. When we look at the SaaS, we see that it has been given a strong boost, more than doubling between 2023 and 2024. And we will see later on, but we can analyze that these manufacturing models that we, as we said also before, which are mainly EV charging, EV batteries startups, have been heavily financed in the past years, and that this sector is now maturing and is now financed differently. So let's look at the B2B slide. Also, mobility remained, as we know, the third most financed sector in Europe. in terms of B2C models. We see a shift. Investors are now focusing on B2B startups that are in general that are more profitable. This has been evident over the last 3 years, with B2B startups accounting for between 83% to 88%, representing 85% in 2024. Compared with pre-COVID years, B2B startups have gained more than 30 points between 2019 and 2024. So we see a global shift towards B2B models. So let's look at the debt funding. As seen above, as a reminder, we've seen in 2023 that the total amount of equity funding was about $9 billion and $6 billion in 2024. So if we do quick math and we add some the total financing in debt and equity in 2023, we are about $12 billion, if I'm correct, in 2023, and about $15 billion in 2024. So we see an increase in terms of global financing in general, obviously impacted by the huge round of nose votes of about $5 billion. However, the total amount of debt financing, as mentioned, has been rebounding sharply between 2023 and 2024, passing from $3 billion to $9 billion globally. And what we can analyze is that the startup in the as mentioned before, in the battery sector, EV charging were largely financed through equity in the recent years and are now mature and transitioning through debt mechanism. And this could explain also the drop in equity investment in 2024. So then it's obviously always interesting to look at M&A activity and exits when we are doing a report on the funding. So let's deep dive into what we have here in the slide. Although the number of exits has held steady over the last 4 years, so around 75 to 82 exits per year, which shows the continuing strong interest of the corporate in the mobility sector and some liquidity opportunities for funds. Even though we know that the value of exits are down in 2024 when we compare it to the exceptional years that were 2021, 2022, but when we take a step behind, we know that we are seeing a growth between 2017 in terms of value and 2024, so pre-COVID to right now, of about 11% annual growth overall. So that's all for me, and I now hand over to you.
Okay, thank you very much. If anything isn't clear in what you've been hearing, the figures that Églantine and Pierre have been presenting, please feel free to send us some questions on Livestorm. As I said, at the end of this webinar, there will be about 20 minutes or so when we will be answering any questions or perhaps reacting to any opinions you have about the tendencies. Now let's go to Clément. As we've just heard from Pierre, a lot of the startups which have attained maturity have been relying on debt or turning to corporate issues. What would be interesting is if you could tell us if there are any kind of bizarre unicorns which have come out, or strange cases. Could you tell us about that?
Yes, definitely. So let's now focus to unicorns. I would not say that there were bizarre unicorns created this year, but for the second year in a row, only one unicorn emerged in the European mobility ecosystem. We do believe, our analysis is that it's mainly due to decline of valuation, of course, but also, as Pierre already said, due to the fact that business sectors that usually contributed to creation of new unicorns over the past years, EV infrastructure and battery manufacturing companies, they now are turning towards more other type of financing, such as debt financing. The only unicorn of this year is a UK-based startup, Wave, which attracted famous and leading global investors such as NVIDIA, SoftBank, and Microsoft. And we do believe that this illustrates one of the key takeaways of this year's report. Despite the market slowdown, tech-intensive companies still attract a lot of funding. Now let's take a look at the top investors of the year. It's a slide that is always awaited by our viewers and readers. Similarly to last year, the number one investor is EIT Urban Mobility with 28 deals, and the second most active investor is BPI-France, the French public investment bank, which is always very present and strongly supports the French ecosystem. As always, the list of investors is very diverse. We have investors from all around the world, of course Europe, but also the UK, US, Singapore. So that shows that still the European market is very attractive. And one information that I would like to mention, even though they're not on the slide here for data reasons, it's important to note that there was a new fund created this year, Shift for Good, who raised 220 million euros. I think we'll hear from them in next year's report, thanks to the money they will invest for sure. We know that this other information is very much awaited by the ecosystem, the split between countries. Who are the leading countries in Europe? Similarly to last year, the top four countries, the four strongholds of the European mobility ecosystem, are the UK, France, Germany, and Sweden. The UK and France contract, as you know, as we already said, by 13% last year, similarly to the global European trend. Germany has increased its volume of investments by 50%, so it's impressive, but they are basically coming back to the 2022 figures. And even though Sweden and Germany switched in the ranking compared to last year, the UK and France remain the two top countries in terms of dynamism. So we've talked about the European geography. Now let's focus on the global geography and compare Europe with the two other main regions that are the US and Asia. So we have to be fully lucid here. Europe is losing ground in global mobility funding. In 2024, it represents about 20%. I mean, it attracted 20% of the global mobility funding, while it had almost reached 30% last year. So Europe is losing ground, and the US is regaining top spot with more than 40% of the global mobility funding attracted last year. This confirms a more global trend, more global information that we can see in the overall tech and innovation ecosystem in Europe, that Europe is falling behind in terms of innovation. This was highlighted by the Draghi report, for example. And we also believe, based on the interview we did with investors, the people we meet on a daily basis, and also entrepreneurs, that regulatory uncertainties, such as the Green Deal, which is being challenged, same for the CRSRD, this adds some uncertainty to the ecosystem, and this adds to the challenge. In short, Europe must act swiftly. That's our recommendation to avoid a long-term loss in terms of long-term loss of ground. Nevertheless, every cloud has its silver lining. So it's important to note one thing in terms of number of rounds and not of volume. So number of rounds, Europe is still ahead of other regions with more than 40% of the deals. So this is very encouraging, and this might indicate a very dynamic market, but that lags from funding. Now let's focus on the sectorial analysis. There were two resilient sectors between 2023 and 2024. The autonomous and sensor tech, which multiplied by 3, it's the money it attracted. Of course, that includes the round we previously mentioned, Wave, and the mobility services that also increased by 50%. Notable deals in that field include field in urban air mobility, Skyports and Autoflight, and also micromobility, which is decreasing a lot this year, but still dynamic with Vapost and the French shared micromobility startup Pony. even though those two segments were dynamic, it's important to notice that two sectors were faced a major decline, and this is in line with all the things we mentioned since the beginning of this webinar. Maintenance and aftermarket, which include in our taxonomy EV charging infrastructure, is declining a lot. Same for battery gigafactories that are included in vehicle production. And I will finish with one sectoral analysis, the autonomous mobility. 2024 marks a record high in terms of funding. We reached $1.2 billion raised. Of course, it's mainly driven by Wave. But we need to be very cautious because there is a sharp decline in terms of number of deals, which might signal a possible slowdown for the years to come. Obviously, and our viewers must know that as they are mobility specialists. Autonomous mobility is a thing. It's becoming a reality. We see that with Waymo in San Francisco and soon other cities in the US and in Japan. BYD announced this week that it will generalize level 3 autonomous mobility in all of their models. So it's a reality, but we might turn towards a potential market structure that will include only a few dominant players, very well-funded players, and this might be a very complicated field for early-stage startups, small startups, newcomers for the coming years. And if you want to deep dive in that topic, we've gathered with the deal room a list of more than 100 autonomous driving startups in Europe, and we'll share with you this list. You'll be able to take a look at it in the final report that we will share with you after this webinar. And that's it for me. Over to you, Pierre.
Thank you very much indeed. Clément, at one stage I thought it looked like you were presenting the Eurovision Song Contest with all those countries and their different points.
France,
I'm
2
sure.
points.
Yes, France 2 points. I did that once. Right, let's deep dive, as you just said, Pierre, about certain subsectors which were highlighted in 2024. Who had success last year?
Yeah, so as previously mentioned, the maintenance and aftermarket subsector is a dynamic sector, is actually the second most financed in Europe in 2024. Even if we see a decrease in terms of investment of about 44% compared to last year. So within maintenance and aftermarket sector, we decided to focus on the smart charging V2G subsector. And we can see that it is increasing strongly by more than 35%, so going from $219 million to $296 million in 2024. And this strong increase is mainly impacted by the fact that, as we can see, major rounds ranging between $100 to $250 million have been impacting this year funding in this subsector. To give maybe some example on those major rounds, we can see, for example, EO charging, as we have the logos here, or Monta, who have respectively raised $101 million and $80 million in 2024. And for us, it's an important subsector, as we see the smart charging and V2G topics are very important for the corporates. We see strategic moves from Renault, for example, which is developing also the service of, they are becoming also energy supplier, enabling their last vehicle, the R5, to be V2G compatible and to do energy exchanges. So it's a really hot topic for us. And last, focus on the subsector, the circular economy. To finish, it's really important. It's a very important sector for us and for the fund in general, as we see it. If we look at the figures, we can see that the circular economy startup have raised about $5 billion since 2019, showing obviously the importance of the subsector. If we look at the two previous years, 2023 and 2024, obviously there was a significant drop in the total amount raised from $1.4 billion to $235 million. But if we want to understand it better, in 2023, the sub-segment was mainly boosted by a deal of $1.1 billion. in Zenobi, which is a company specializing in second-hand batteries for stationary storage purpose for vehicle fleets. And if we exclude this mega round of $1.1 billion in 2023, we see that in the past 3 years, we are almost flat with around $300 million in funding. And what's also interesting in 2024 is that we are seeing a greater diversity in terms of type of a startup that were that were funded. Sorry. With growing topics related to second-hand goods and also materials that are growing in 2024. And we believe that it's a major sector that tackles really highly strategic problems for the corporates, the OEMs, the Tier 1, for example, that are facing and that will face also in the future some challenges on this.
So, Eglantine, if you've been listening, lots of figures, quite a lot of analysis. If I could just ask you to close this particular part of the webinar, the 3 takeaways, what would you say were the 3 most important trends to comment on?
Yeah, so firstly, of course, overall funding, VC investments, VC startups raised $6 billion, a 30% drop, with most of the drop coming from late stage volume-wise, not deal activity-wise. And also a drop that's really outpacing the European average by 3-fold. EV infrastructure and manufacturing reaching maturity, turning to debt financing, also corporate investors having a lot more involvement, twice as much actually than 2020. Also the market favoring B2B, asset light and technologically intensive business models. Also autonomous vehicles and sustainable aviation being present in the top rounds, but also emerging markets like V2G and circular economy. Overall, Europe it continues to be a global innovation hub, accounts for 40% of all deals in the sector. And yeah, just overall a shift in the industry with more funding directed towards B2B and scalable solutions.
Okay, thank you very much indeed. Please ask us your questions. Feel free once again on Livestorm if you want to ask Eglantine, Clément or Pierre any questions, feel free to do so. We're going on to the second part of our webinar now. We're delighted to have live connections with Nate Jarrett and James Jackson. I think they're with us. I hope I pronounced your name correctly, Nate. First of all, could I ask you both to introduce yourselves? Nate, first of all. It is Nate, right? It's not Nate, Nate.
It is Nate.
Perfect.
Hey guys.
Hi.
Nice to meet you all. Thank you for having me on. Appreciate all the hard work that's gone into this report, and it's great to be here and chat with you guys today. My name's Nate Jarrett. I'm a partner with a fund called Maniv, sometimes known as Maniv Mobility. We've been investing now in the broader transportation space for about 8 years. We're investing out of our third fund, headquartered in Tel Aviv and an office in New York City, investing mostly at seed stage, a little bit of Series A, but really mostly focused on quite early stage investing. And yeah, really glad to be here today.
Okay,
over to
perfect.
James.
You're in Tel Aviv, right? You're calling us from...
I'm based in Israel, yes.
Right, okay. James Jackson, you're from Bumper. Where are you? And could you introduce yourself? I don't think we can hear you.
Apologies.
Yes,
Hi,
perfect.
yeah, just to echo Nate's comments, thank you so much for inviting me onto this and for the great reports that you guys produce. Yeah, so I'm CEO and co-founder of Bumper. We're a payment platform for the automotive industry, particularly for car dealers. And we operate in a lot of the main European markets. So I'm based in Northern England, have an office in London as well, and we have a large presence in Germany, in Spain, the Netherlands and Ireland. Our core product is buy now, pay later for car repairs, but we also do digital payments, in-store payments, and we recently bought a business at the end of last year called AutoBI, which is a business intelligence tool. So using big data to produce really intuitive reports for large manufacturers, but also for the dealers themselves.
Perfect. And where are you calling us from? Where are you, James?
I'm in the Peak District.
Oh, right.
Pretty cold, hence why I'm wearing a few layers.
Okay, well, let's try and warm you up with some of the hot questions that we're going to ask you. Nate, first of all, can we start with you? You've been listening to the figures that were presented. Can you give us your first reaction to them?
Yeah, I think that there's a lot of ways to think about these sorts of things. And I think it's also important to maintain perspective and not lose the forest for the trees, in the sense that year by year fluctuations are normal, and we should not expect, we shouldn't expect neat linear trend lines in everything in life. Life is a very volatile thing, and that's especially true of the financial markets. I think that the right way to think about what's going on, in the broader venture space, and I see mobility investing as just a subset of that. Ultimately, we are talking about technology investing as a category, and mobility as a subcategory. I think it's important to really look at this from a macro perspective and understand that we are no longer in the zero interest rate period of 2020 to 2022, and so we should expect now, a few years after the interest rates have started climbing, to see the cascading effects. And those cascading effects are varied, right? There's obviously the angle where, especially later stage investors, and I think that that's best reflected in some of the data you showed around mega rounds, the opportunity cost for institutional investors, remember the people that are putting money into the funds that are backing the VCs, the opportunity cost for them to back high risk, quote unquote, later stage companies in the venture space has become a lot less attractive in a world where you can now get 5% risk free from a bank just by letting your money sit there and do nothing. That's an important meta reality to keep an eye on. I think that more specifically as it pertains to mobility, I think in many ways it's useful to see mobility as the anti-venture bet in a lot of ways, right? The reason why institutional investors put money into the venture capital asset class is to have a percentage of their overall portfolio uncorrelated with the broader public markets, right? The public markets, and tightly in lockstep with that are the real estate markets, is where most of their portfolio sits. And then they allocate 10 to 15% into private equity. And within that 15%, it's private equity. Within that 15%, 10%, it really is about 80% in fairly low risk private equity, traditional private equity, buyout, LBOs, and so forth. And only 20% of that 15% is going into high risk venture. The reason why they invest in venture is on the off chance that they will hit another Stripe or a Facebook or a Google or an Apple or a company that can become a multi-billion-dollar company. That's the broader perspective, and it is true that most of the companies that are getting funded in the venture space specifically are pretty typically high margin enterprise SaaS style companies. Now, there are obviously exceptions, but the lion's share of venture capital money goes into these high margin businesses that, if you ask me, and we're obviously more comfortable investing in the mobility space, there is a certain upper limit to how big those companies can get. I don't think we're going to see a lot of cybersecurity companies that become as big as Tesla. I don't think we're going to see as many productivity tools that become as big as some of the big OEMs or battery companies and so forth. And the reality is that these industries are in mobility, this family of sectors that we call mobility, manufacturing, energy, transportation, logistics, supply chain. These are asset-heavy industries where the upside is virtually uncapped, but it takes a lot more money to get there. And when it takes more money to get there, when interest rates are high, the risk appetites of institutional investors are simply going to change, and that's going to take a disproportionate effect on the sectors that we all care about here in this room.
Okay, thank you very much for that detailed analysis. James, the general downward trend at the moment, you managed to raise quite a lot of funds in 2024. What would be your recipe, and what would be your analysis of the trends?
Yeah, I mean, I think the report resonates very strongly with what we saw. So we did our Series A in 21, where we were flooded with term sheets and closed pretty quickly at a much elevated valuation than we were probably expecting when we started.
Good problems to have, James.
Yeah. We then did our Series B in 23, and we're mobility and we're also fintech. So we were really hurt by Klarna having a huge down round the year before. I think it's from $46 billion to $6 billion. So a lot of fintechs were wary of BNPL, which is one of our core products. But then also when we did our extension round last year, we're very reliant on mobility CVCs. And clearly with the transition to EV, a lot of them are having a pretty difficult time right now. And if you're having challenges for your main business, are you going to be as probably adventurous in your investments? And a lot of the CVCs aren't ring-fenced dedicated funds. They're balance sheet lending, so they're very easy to pull back if times are more challenging. So certainly we found it much harder. It took a lot longer. Probably took us around 9 months to close our Series B. A lot of no's. I think we had 100 rejections. So it was hard work. But I still think if you're a good business, if you're growing strongly, big market opportunities, there's still money to be raised. There's a lot of dry powder out there. So certainly harder, but still, we're very bullish for the mobility sector over the coming years, particularly in Europe.
Okay, thank you very much, James. Now, Nate, we've seen an increase in fundraising by B2B asset-light and technology intensive startups. The best example is Wave, which we talked about with over $1 billion raised, but there are a lot of other ones. Do you think this is the start of something which is long-term?
I think the key thing is that good companies are always going to get funded. I think that one of the things that stood out to me in the report, and I'm going to come back to your question in just a moment, but one of the things that stood out to me in the report is that the deal volumes, for example, in Europe are actually higher than they are in the US, but the amount going in is lower. And I actually don't see that as a good thing. I think that deal volumes are not a KPI to pride ourselves on. Right? It is not about funding the most number of companies. It is about funding the best companies with the greatest chances of creating long-term value for everyone. And I think that as it comes to your question, right, we're seeing more fundraising going into B2B companies and asset-light companies and technology-intensive companies. What that actually means is that less money is going into B2C companies and less money is going into what we would call maybe business model innovations. I think Bumper is a great example of a company that is bucking that trend. But the challenge is that again, going back, and forgive me for going back to the interest rates, right? When part of it is simply around perceived risk in B2C companies, right? Because I think the 2017 to 2021 were a period of great experimentation in mobility B2C models, whether it was free-floating scooters or car sharing or a number of other things. And it turns out that it's really hard to build a business that's reliant on consumer altruism, that is taking care of the assets when the company is not. And a lot of these companies, yeah, some of them are making a bit of money, some of them are losing a lot of money, some of them are doing okay, but we have not seen any humongous explosions of positive explosions of B2C mobility companies that have not since declined in a pretty meaningful way and reached some sort of regression to the mean, some sort of steady state that is no longer what would be considered a venture outcome. I think that what you're describing as this movement towards B2B companies, towards asset-light companies and technology-intensive companies, is what might be described as a quote-unquote flight to quality that we should expect to see in market downturns. That shouldn't be alarming. I think that first of all, it's a good thing that deep tech companies are getting greater access to capital. I think that certainly if you care about decarbonizing transportation, it is not a software problem. It is a hardware problem, and we need to throw a lot of money at hardware solutions, at chemistry, at battery technology, hydrogen technology, and things that are, not quote unquote easy, right? So I see this as a natural reaction by the private markets to find companies with less perceived risk. They might be wrong, by the way, and I do think that there are still businesses that can be built, first of all, across borders, which is a little bit difficult in Europe. To build a B2C company across borders is proving, especially in the mobility space, very difficult. But yeah, I think that this is normal and expected, and one that actually bodes well for the industry as a whole, to get money into companies that are a little bit less experimental and a little bit more on solid footing. And you can see the results of the capital being injected into these companies at a faster, less speculative pace. So yeah, it makes sense to me that this is what would be happening now.
Okay, James, we see in the study that CVCs are present in 44% of the round in 2024 in the mobility sector, and we've seen that many CVCs in your cap table today. I'd like to understand what's the logic behind choosing to raise money with CVCs, and how important do you think they are generally in the mobility sector?
Yeah, I mean, we love CVCs, and they're a big part of our fundraising strategy. We raised just under $50 million for our Series B, and from that there were 7 mobility funds who invested, 6 of which were CVCs. A lot of them car manufacturers, so Porsche Ventures, JLR, Suzuki, a few of the Japanese mobility funds, Itochu, Marubeni, and then Shell also invested. So yeah, we took the strategy of trying to be the Switzerland of CVCs. We didn't want to take money just from one of the manufacturers and risk alienating ourselves to the wider audience. So one of our prerequisites was that we'd take money from at least, it had to be a minimum of 2 for our Series A, and we continued that trend on. For us, it was the right move because our clients ultimately are the OEMs. So we felt that by taking funds from them, would have a closer tie with them. It would be a kind of a win-win situation. Our business intelligence tools are built specifically for the big car manufacturers. So taking that investment opened lots of doors. It gave us that credibility when we were talking to Porsche or the VW brands or the Jaguar Land Rover brands all over Europe. It would really, really open those doors. So that was a huge part of our strategy. And as your kind of report suggests, clearly these are businesses with deep pockets, with huge multinational positions across the market. So clearly they're going to add a lot of value to startups. Much more so than in many ways a typical generic kind of VC. So certainly it really worked for us, and we would really, really recommend CV investment from other up-and-coming startups in the mobility space.
So as an entrepreneur, it's very interesting to have you, James, because we'd like to get your feeling for what's going to happen in terms of the general mobility, the dynamics of the mobility market over the next few years. And do you have a vision of the subsections and the innovations that are going to be making the news?
Well, I mean, it probably wouldn't surprise you to hear me say that I think BMPL for car repairs, kind of vertical BMPL, is going to become more widely used across Europe. It's still pretty new in Germany and Spain, some of the new markets we've got into, so we think that's going to be a big area of growth. Of course, AI is touching every part of society, and we're really excited by the potential of AI in diagnostics for car repairs. Also for things like kind of workshop efficiencies. There's a lot of margin that dealers can maximize from really leveraging AI. And of course with connected vehicles, big data, again, plugging that into kind of machine learning and AI tools could be something really, really powerful for the businesses that can really make the most of that. I think we'll be in a great position to grow very strongly over the coming years.
Okay, and just one final question to both of you. Nate, do you share general optimism, because the sector does remain in the top of the most financed sectors? Is that going to continue? What's your general feeling? Are you optimistic for the coming years?
Yeah, I'm super optimistic. Maybe simply because this family of sectors and industries we call mobility are simply part of the backbone of human prosperity, and it's very hard to escape that reality. I mean, these are the great companies that are being built in the broader transportation space are helping people and goods get around cheaper, faster, safer, and these are things that we need to happen as societies. People can get around means that they can get better jobs. It means that the economic engines keep on turning, right? You can correlate GDP with the amount of trucks that are moving around. I mean, that's just basic math. And so our continued economic growth and prosperity are reliant on bottom-up innovations in this world of transportation, which on the one hand is positively huge. I mean, this is endless market cap territory, but these are also industries that are still quite analog and still quite old-fashioned in many of the ways that they do business, which they're able to do because of their historical size. Now, that logic is going to get tested as new technologies and new business models continue to innovate and continue to create on-the-ground change across our societies. And so I'm optimistic because the businesses that are being built in the space are exciting, they are important, they're tackling things that are more interesting, if you ask me, as a mobility investor, more interesting than productivity tools and scheduling software and whatever it is. This is the stuff that just take something that people would think, financing vehicle repair is a really, really boring topic. I don't think that's a boring topic. I think helping people make sure that their 12-year-old Corolla is up and running so that they can get back to work, right? That's romantic stuff. That's incredible stuff that ultimately allows our societies to keep on thriving. So I'm fundamentally optimistic. I think that these innovations and these business models will continue to create prosperity, not just in our societies but around the world. We're invested in two-wheeler OEMs in India, which are going to create a new middle class in historically poor countries. And I think that when you bring down the cost of transportation and logistics, that is a fundamentally good thing. So we're excited, we're bullish, we're all in.
You seem very bullish and excited indeed. Thank you very much indeed. You've been asking us quite a lot of questions suddenly coming in. We've got about 12 minutes, so I'm going to ask you all for quite brief replies if possible. So these are the questions you sent in. Let's start off with one or two of them. The amount of investment is similar to 2019. Can it still be considered significant if we take the years when COVID was withdrawn as exceptions? Clément.
Yeah, I can take that one. We still do believe that it's a very significant amount. Let's remember where we come from. 10 years ago, the overall quantity of funding in Europe was really, really lower than that. And as it was mentioned by Nate, we have different waves of innovation. So we had a lot of experimentation around B2C businesses, micromobility, mobility as a service in the let's say last 7 years, 5 to 7 years. Now it's a new wave which is coming, more related to AI, deep tech startups. So we were just facing waves, and of course there is this also information that Nate also mentioned, that money is not free anymore. So we are still super bullish, and we believe it's a significant amount. The sector is full of promises, and again I will conclude on that. Mobility is a basic need. It's the backbone of our economy, of the middle class. So we still believe there is a huge market for mobility startups in that field.
Yeah, and if I can add some figure, just to remember, as mentioned before, we are still in the top 5 most funded sector globally by VC, and it has been like this for the past 10 years, and we are the 3rd most funded in terms of B2C models. So we really believe that it's an important need, and the startups will be in the mobility sector will be pretty well funded in the future, as corporate actors will really need those innovations to face their challenges, OEMs, Tier 1, etc. And also that we will be doing innovation also in B2C sector.
So very bullish here in the studio. Also, next question, why does the UK attract so much funding when investors are largely from continental Europe? We're going to mention the dreaded B word. Who would like to take that one?
I can start, but probably James can answer better.
And then James, yeah.
I think the UK in every market is investing the most. They're always number 1 in every market. Mobility is no exception. So I think that's just, they have a lot more VC in place. They've been funding for many more years. I think VC in the rest of Europe is more of a newer trend. So that's the case, and they have a lot more entrepreneurship and so on. But I think, yeah,
James would you like to tell us why the UK is doing so well?
Yeah, I mean, it's definitely not because there's more talent, but I do think there is some advantages the UK has. Clearly, the language of the US, we're probably more influenced by the US than the mainland Europe. I think we have a lot of quality universities. If you look at the top 10 universities in the world, it's normally Oxford, Cambridge, and Imperial normally rank up there. I'd also say, we've set up businesses across Europe, and it is so much easier and quicker just to set up a company in the UK. You can do it online in minutes. Setting up a GmbH in Germany, oh my word, it takes forever, weeks, months, and Spain. So I do think there's less red tape in the UK, which certainly helps starting up a business, cost less, those kind of things. So I mean, there's a number of reasons, but certainly I'd factor those as some of the main ones.
Okay, thank you very much. Another question was sent in. What is the trend on fleet sharing business? Clément?
I can try to answer that and try to answer via taking a more broader view on the topic of fleets. We do see a lot of innovation in the field of fleets, of course. Why so? It's because fleets are where a lot of trends meet, connected cars, AI, of course, so everything which is around the connected vehicles, and also electrification, which is impacting a lot fleets via new questions that they raise: the cost of insurance, residual values of vehicles, how do you repair EVs, how much does it cost? So there is a lot of challenges there, and we see a lot of startups in the field of fleets. Just for France, I can mention Nelson, Guided Energy, or Pelican Mobility, for example. But there are all around Europe startups in that field. And maybe to finish answering the question, we see also a lot of startups that are indirectly providing solutions to that field. Startups around AI or connected cars, for example, also participate in bringing innovation in the fleet industry.
Yeah, I was going to say the same, that we've been seeing a lot of EV fleet management startups arise, and yeah, they have kind of dual business models, so either with leasing as well as the fleet management, or using AI. I think there is one company, Timefold, they're like an open source AI, and then they do fleet management, but then they also can do any type of scheduling, so really varied applications there.
Okay, we have another question. Which startup raised the mega round in 2023 for sustainability?
Well,
can anybody answer that one?
Actually, I don't know if you
You
have
said in circular economy, the one that was really the battery recycling.
We have globally. We had maybe if we can go back to this slide. that I was presenting before. So yeah, what we see here is that we had a lot of investment in terms of battery recycling. I've mentioned Zenobi, which raised $1.1 billion, something like this. So yeah, we had a real focus into this type of models, battery recycling. But I don't have the particular detail of the other startups. But we can
provide that afterwards.
Yeah,
absolutely. How do you see the carbon credit adoption in the mobility space? Another keen theme that everybody's talking about, carbon credits. Anybody like to take that? Eglantine?
Yeah, maybe I can start. I think that's definitely going to be something that's going to move forward, also because I think automakers are really behind on their targets. I think they were just revised now recently, but overall they're going to need to rely more on carbon credits because, yeah, they're definitely behind on the sustainability-wise.
Okay, another question just come in. With historical European players, particularly in the automotive sector, facing challenges recently, and given the significant role of CVCs in this industry, do you foresee a downturn in the mobility market? Would like to take that one.
Yeah, sure. So, as mentioned before, yeah, we have CVCs are representing 44% of the global investment. They take part into 44% of the deals in 2024. It's long-term trends. They have been really important for the mobility sector. Obviously, we see some challenges, as I was mentioning before, for tier 1 OEMs right now, with a lot of competitors coming from other geography. But I really believe that in those moments, right now we have a momentum in which tier 1 and OEMs have to really react and face those challenges. They will have to seek for more margin, and for more innovation. So obviously they will have to. It will create opportunities for startups. We were mentioning AI. SDV data, everything, but also operational efficiency. AI is really interesting for this. So yeah, what I see is that in the future, those CVCs will really impact the sector, still impact the sector, and they will create new opportunities and momentum.
I'm very conscious of the fact we still have Nate, I think. Nate, I don't want to not hand over to you. Do you have any comments on any of the questions that have been asked? Do we still have Nate? Maybe not.
I'm still here.
Yeah, no, go ahead. Do you want to make any comments? I didn't want to ignore you if you want to come in on any of the questions.
No, I think they're great comments and great reflections. I think that ultimately we should expect to see a natural ebb and flow across sub segments of mobility, and it's also true though that there is some big questions around the way that startups can expect to interact with OEMs specifically, especially technologies and businesses that aspire to get into the car. I think one of the things that we've learned the hard way, and maybe James and Bumper have been spared from this, but getting a technology into an actual car, a production vehicle in partnership with an OEM, is really a mountain that most startups will have a very hard time climbing. Part of the challenge is simply structural. You can land that POC with the OEMs and then turn that into a pilot and then start talking about the final details of how to implement the technology once you pass that thing, and then it gets to the procurement department, and then they look at your balance sheet and they're like, wait, what do you mean you have 13 months of runway? How can we possibly work with you? And so there's a structural challenge, and I think we've learned the hard way that technologies from startups don't often make it into the car without a pathway to revenue generation across other industries that are not just selling to car makers. Car makers have proven to be very ambitious and also very hamstrung when it comes to adopting early stage innovations into their value chain.
Okay.
And so I think we're quite wary of that type of proposition.
Okay, perfect. Just one quick one with one sentence, because we've got about a minute left. What are the main challenges preventing investors from backing deep tech solutions in mobility? One word answers. What would you say, Clément?
Deep tech startups are riskier. It takes more capital to, mainly in most cases, more capital to develop, and the business it will create and the money it generates will be in a far away in time. So yeah, it's riskier for investors.
Perfect. Eglantine, one word.
Yeah, I was just going to say also, since we're seeing this shift from B2C to B2B, I wanted to ask actually, like, how are investors equipped to deal with these emerging technologies? I think that's something to deal with now. So.
Okay, perfect. Thank you very much indeed. Eglantine, Pierre and Clément here in the studio, to Nate and James, and thank you to all of you for watching. Can I just point out, I think you have a QR code which will appear on your screen. The figures we've been presenting today. You also have, on the 20th of March, there will be a report, more specifically French, for l'Observatoire des Startups de la Mobilité, which is an observatory. Thank you all very much for watching from Paris. Goodbye.